Yeah, Roth conversion obviously comes to mind, and that has been a conversation with a lot of clients. Um, you know, the basics of it is we're taking pre-tax money in a year when we can avoid other income sources like RMDs and potentially getting it at a lower rate. And, there's a lot of obvious reasons that come to mind as to why one might want to do that. Um, moving money out of a qualified account to a Roth, it comes out tax-free down the road. You also can think about passing on tax-free assets to heirs. That's a big one. They'll still have to take an RMD upon inheriting if they're a non-spouse, but it comes out tax-free. I think the other big one is Roth or IRAs, right? There's no required minimum distribution. So there's a lot of opportunities if it makes sense. I think there's also a lot of considerations that folks need to be aware of before they pull the trigger, because as most of us know, it is irreversible. Once you pull the trigger on a Roth conversion, you can't go back and undo it as you could previously. So Jack, do you have any insight as to some of the considerations a client might want to be aware of before making that decision?
Sure. I know one thing that we look at for clients is what is the current income tax bracket, obviously, because on any type of conversion, that's potentially what they're going to look at paying tax on. And then what is the likely income tax bracket further down the road? The likelihood of income tax rates increasing in the future is, we would think more probable than not, but always looking at what tax bracket, because just because income tax rates rise doesn't mean a client may be in a higher income tax bracket down the road. They might be in some of their highest income earning years now, so which might force them into a higher bracket now as opposed to in the future. So definitely I would think income tax brackets, what's their current income tax situation compared to, what they might be in the future is definitely a consideration. How about you? Anything else you think through?
Sure. I think of a couple things, right? The 5-year rule, having the money in there for 5 years after the conversion. So if you're planning on using it the next year, probably not the right move in terms of the conversion. Also, how are you going to pay for the taxes? A lot of people take IRA distributions and they have withholding automatically from that distribution. You can still do that in theory, but that may push you up into a higher bracket, may not be the best decision. So maybe having funds outside of the IRA in the bank account, for example, available to pay, any additional taxes that the Roth conversion might make you incur. And I think a smaller yet some folks might be aware of this or not is the IRMA adjustment, income related adjustment for Medicare Part B and Part D premiums, right? Putting too much Roth conversion on the tax return, along with having other sources of income like interest, dividends, Social Security, maybe a defined benefit pension plan. Folks will definitely want to be aware of those limits, those thresholds, and stay below, or they're going to be in for a surprise when it comes to their Part B and Part D Medicare premium adjustments in future years.
You bring up a great point. I think not only just looking at the income adjustment on the Medicare premiums, but also the taxation of Social Security as well. Because Social Security in and of itself opens up a whole can of worms as far as what amount becomes taxable. If the client has no other assets other than, let's say $1 million IRA or $2 million IRA and Social Security, and you start adding on, distributions, let's say pre-72, that can potentially impact the amount of Social Security that's taxable as well in any given year.